All right, so everyone, welcome back. It's been a pretty long time since I've done an IMR, as most of you watching this will probably know. So there's been I think, more than a 3-month break since I did the last IMR. I think it was sometime in Feb. So we are now on the 11th of June. Uh, and well, why there was a break, etc., is a long story. I'll get into that at some other time. Some good things happening. Anyhow, so we are doing this IMR sort of at the spur of the moment, and it's just been something that I've been thinking of doing for some time now. So I just said, okay, let's do it today, and sent out the post, a ping, and those of you attending live, thank you for joining in. And let me just start by first saying that this is perhaps one of those, in some sense, a high risk IMR that you're doing. There's a very good chance that a lot of what I say today could completely go topsy turvy. And the reason is very simple, and the reason is this, right? Uh, I think the title on CNN.com says it all. There's the Trump and Kim summit tomorrow in Singapore, as you know, 9 a.m. Singapore. So in about 12 hours from now, or rather India time 10 hours from now, it'll get underway and we'll see how it goes. So given the unpredictability of this event and the great expectations which I think are on this particular event, who knows, it could be a big make or break in many ways. For a lot of things, for a lot of people, for a lot of institutions, and maybe in some ways for the entire world. So if it's going to come out all, positive, etc., there's going to be some very significant consequences. And if it, ends with acrimony like the recent G8 summit, or G7 summit rather, which ended day before yesterday in Canada, as we all know, and the acrimony with Trump and his Twitter fusillade. So we don't know, and but all said and done, sort of feels good to be back, and let's see what the market has been up to, and leave the future in the hands of these two gentlemen, and we'll see where it goes. And before actually jumping in to the IMR, there's another point I wish to make. For those of you who have attended the Equity Next Step course over the last, several years, almost a decade, I would think. I hope you remember that in the EQNS course, one of the things that we used to speak about quite in some depth, and some of the sessions were turned out to be very, very interesting in the last weekend of the EQNS course, was geopolitical factors. And if you remember, we kept saying that, and we've been saying this for almost 10 years now, that we never know when the North Korean issue could get resolved, and if it gets resolved, what are the sort of opportunities that could open up for you know for many, many ways. But sticking to the theme of investing on the webinar today, that North Korea, an entire country which is basically maybe 50 to 100 years back in time in terms of anything and everything, from agriculture to development to infrastructure to education to healthcare to just about anything, there is a huge, 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 huge opportunity. And if, and that's the big if, and of course, tomorrow is not going to be the be all and end all of it, but if the summit goes well, then there's something that amazing that has come at our doorstep, that I want to reiterate we have been talking about repeatedly for 10 years in the EQNS, which is the North Korean country not being a pariah anymore. And if the border between South Korea and North Korea is demilitarized, and I mean it is already, sorry, the DMZ, and if political contacts get reestablished. Just to point out that there was the second meeting between the president of South Korea and Kim when the things had gone completely down with Trump and Kim, and the summit was called off. There was a second meeting, a lot of camaraderie, etc., and a lot of visuals. So I don't know. I mean, I don't think anybody knows in this world what the hell is really going to happen or heaven is going to happen there. But I'm just so glad that at EQNS in BIC, we've been speaking about it. And we've been speaking about other hotspots in the world also. The one thing we kept saying is we never know when this could happen, but it could happen. And we also kept saying that it could happen in our lifetimes. So this is one very long shot prediction, which maybe coming true. I'm really happy to have been in that conversation with many of you guys, and I hope some of you guys remember. And just to reiterate, the opportunity in North Korea in terms of many things, whether uh, you want to go visit, tourism, etc., could happen this year, next year. But in terms of investing, the two countries which are going to benefit the absolute most is South Korea. We kept saying in our conversations, if you remember, South Korean companies would be the ones to buy their shares on the stock exchange of Seoul if there is a way to do it, or just buy the South Korean index ETF if there is something somewhere. I'm sure there is. For those of you looking at international trade and investing, this could be, well, I wouldn't say once in a lifetime opportunity. I think lots of opportunities in a lifetime, but definitely once in a 5-10 year opportunity. You have to really understand that when a country is going to be developed from scratch, the absolute humongous amount of wealth that is going to get generated, and a fraction of that is going to be enough to make any of us a fortune that could last us many lifetimes. So any of you willing to really put your limb out, maybe even travel there, who knows, or at least to South Korea, explore and do some deep research into how one could take advantage of it. It is at your beck and call. I think, and by the way, even if it does not, the summit tomorrow is a dud. I don't think it's the end of the road. Something is going to happen in the next 6 months, 1 year, 2 years, whatever it is. The apart from the South Korean companies, the other big country which is going to benefit massively from the opening up of North Korea will be China, right? And the Chinese companies are going to flood into North Korea. Remember, China is the biggest trading, friendship, political big brother partner of North Korea. And China is not going to let North Korea go out of its sphere of influence just like that. So you're going to have the South Korea, which is going to be a proxy in a sense for the US, and China is not going to keep quiet about it. If of the South Koreans just taking over North Korea in a sense. So anyhow, glad that we are doing this session on the brink or the cusp of this potentially world-changing event. Let's see. The most that we can expect is the conversion of the armistice into a formal peace treaty between US and North Korea. North Korea and US are technically still at war. They have not signed a peace treaty. So if that happens, then that whole Southeast Asian geopolitics completely changes for the good, and who knows what could happen out of it. So yes, hope I really hope that at least some of us in BIC take advantage of the fast changing situation which is there. All right, so enough said about that, about the discussions that we've kept having in EQNS, and like I said, really glad that we could speak about it. All right, so since it's back after a long time, I am not going to take too much time to do too many other things, but I will just jump into the Indian market directly and take it from there and see how things go. Taking a sort of longer term view, not going to comment so much on short term opportunities for this week or next week, though if I find something compelling, I will point them out. I think, like I said in my opening comments, depending on what happens tomorrow, a lot of stuff that we discussed today could be completely a dud, right? So putting my neck out on that, and also, I guess, putting out a qualifying disclaimer on today's session, right? So with that, let's jump in. What you see is the Nifty chart, and well, what's happening on the Nifty is a sort of, in the long term, if you look at it, if I make it a weekly chart, you're still seeing a pretty strong uptrend sort of move, but this part of the move, as it has tried to go up, is clearly petering off. You can see on the weekly side 2 weeks of, or 3 weeks here of candles with long shadows. So, the long-term multi-month uptrend is definitely there. But if you start looking at a shorter term perspective, then these are levels I would watch out for in the near future. And this could sort of, become a topping out pattern in the weeks to come. Can't rule that out. And well, there is sort of neckline there, a potential head and shoulder top, left shoulder, big head, and a right shoulder still working its way. Maybe, may not be. So these would be the levels to watch on the long-term multi-month basis. Now, something could really happen tomorrow and we could crack down or to up. I don't know tomorrow, but from a longer term perspective, this is what is there. The big other thing on the Indian market, of course, is our um, general elections, maybe at the end of this year, definitely early next year. So that brings in a lot more of iffiness and a wait and watch approach to the market going forward. Coming to a daily chart of the Nifty, well, clearly we are seeing, this is the same thing, looking at it, oops, sorry, from a longer term perspective. So even here, we are still, seeing a nice uptrend. But as you can see, you're getting this sharp up moves and then big down moves and a sort of topping out pattern, which is perhaps happening. And you can also see the nice shooting stars, which are happening about a month back and then again, today. So the up moves clearly not being sustained. We'll have to see how this pans out. So overall, the market is a clear wait and watch type of market with no clear direction as to whether it wants to go up or down right now. For all practical purposes, from October last year to now, we are more or less at the same level. So that's a good almost 6-7 months, and for all you know, we could end up going like this for many months sideways without any clear directional bias up or down. Coming to the Nifty Junior, well, or the next 50 as it is now called, and clearly this one is showing us a different pattern. And you can see that while the large caps in the Nifty seem to be still holding out on strength, I think clearly here the uptrend is broken, and we can clearly see a perhaps a downtrend in the making. Lower tops there, lower bottoms not yet there, looking iffy, but a trend looking, a downtrend looking clearer here than in the Nifty. And even the moving averages have, sort of topped out in the next 50 index, unlike the Nifty, where the moving averages are still going up. In the next 50, the moving average seemed to have topped out, and perhaps we are now seeing a trend towards the downside, which has started almost maybe at the beginning of the year, and but not yet confirmed. We don't yet have a lower bottom. So while the large caps still holding out, the less the second group of large caps not really showing great strength. CNX 500, well, same similar sidewards movement like the Nifty, so really nothing much to comment on this, so I'll move on. So from the narrow to the broad index, we are not really seeing a strong upward directional move as it was there in 2017, or through the end of 2017 till 2018. 6 months almost into the year, and more or less sideways to, I would say, a bias down. Coming to the sector indices, looking at the bank Nifty here. So, some banks have still been doing quite well. And here, Bank Nifty struggling to go back to its life high, just like the Nifty also is. Again, here the whole issue is things like It tends to go up nicely, and then the uptrend suddenly snaps in a day with a shooting star like this, or a huge, massive bearish engulfing like this. And these are all daily charts. Uh, Ramesh, you're saying a triangle in which chart? I think maybe you're referring to this. Sure, could be, right? Yeah. All right. So clearly, at the very least, triangle is a consolidation, right? And it's a wait and watch. A breakout could take it to 10,000, or breakdown on the lower boundaries, and also the 200-day moving average there could definitely take it down. Interesting how it coincides with, event, all these things, and somehow the market seems to know that, right? Uh, right. Okay. Thank you for pointing that out. Right. Okay. So on the Bank Nifty, moves up, but this is definitely a place of concern or caution, perhaps, if not concern, which is, one second. Where is this? I want to take this out. Right. And what I want to point out is, this sudden drops that you get seems to be going up nicely. You got this big crack in Feb this year, and again, you're sort of getting this big crack this year, or rather last week, right? And 5, 6, just making sure my data, yeah. So this sort of moves, and also anything definitely on the bank. You all know that the RBI increased interest rates by a quarter basis points after 4.5 years. Expectations of more, inflationary pressures. That really, in the long term, can't be good for credit growth, for the economy. And a lot of political noise has happened lately on the price of petrol and diesel. Of course, the government hasn't budged on that. Along with that is our weakening rupee. The weakening rupee and the high crude oil prices are going to put a pressure on the Indian economy in the next few quarters. And if that goes from bad to worse, we could definitely see the banking side getting a hit. So watch out for that macroeconomic factor, right? All right. So, like I was saying, this sort of big, huge, bearish candles which happen around the same price on a repeated basis. Now, when I say repeated every 3, 4 months here, is not really a healthy sign. So, definitely a bit of concern on the bank Nifty. The PSU banks on the other hand, just going from bad to worse in a sense. Something keeps happening. This, of course, last November was the big recapitalization plan by the government of India, which Jaitley announced, and you had this big, massive up gap, all closed and lost. And the Nirav Modi scam happened, and one skeleton after the other keeps coming out of the PSU banks. And this sidewards move, you must keep in mind. Wow. Okay. So unfortunately, the PSU Bank Index, which has been created by the NSE, we don't have too much historical data, but essentially what you can see is from 2011 to now, for a good 7 years, we really have not done anything on the PSU Bank Index. So really no reason at all to be in any PSU bank from any perspective. It's just a sort of seems to be a sector which has huge problems, and one after the other they keep tumbling out. One big relief to the PSU bank sector is the insolvency code, and you may have noticed, I think about 2, 3 weeks back, when they sorry, a month back or something, when the government said that the existing promoters of companies which have defaulted on their loans to the banking system will not be allowed to bid out of solvency. And suddenly, in a few weeks, you saw a lot of loans getting repaid. Suddenly the money appeared. Obviously, it had been scammed away legally, illegally, by brilliant accounting means, and suddenly this money appeared back. And some of the NPAs got solved, and a lot of the banks were happy with that. One case in point being a company called Electrosteel, which had some massive debt, and all the consortium of banks had 100% written off that debt, saying that this is a write-off. And then Jindal Steel or JSW Steel, something like that, I'm forgetting, bought out the company with a 50% haircut. So the banks got at least 50% of their multi-thousand crore loan back, and that was a big relief. So things like that happening, but I think in the long term things really not looking good at PSU banks at all. So really no compelling, there is, I mean, forget compelling, there is no reason why anybody should be looking at any public sector bank for any reason at all. Definitely not for investing, maybe for trading, but I'm sure there are many other good trading opportunities out there, but which are far better placed than anything in the PSU bank space. So, and basically, as usual, for a long time, whatever has been driving the market up has been the private sector banks and not the PSU banks. So, we'll have a look at those in a little while. Coming to the other major indices, CNX IT, that has been perhaps one of the biggest reasons why the Nifty has been able to stay up, right? So, the CNX IT, the IT blue boys of India, their stocks have been, making lifetime highs in the last 6-7 months, and actually from the last almost 7 months for sure. That was definitely a very good sector to be in. And if I remember correctly, if any of you watched or attended the um, fundamental analysis review that we did sometime last year, where we looked at a deep analysis of FA. I think we very clearly mentioned that the IT space was undervalued and was a very good low risk investment opportunity. The entire sector was well placed for a value buy. Anybody did that, I'm happy to say that on quite a few of the stocks, you did at least 50 to 80% profit in less than a year, maybe even 100% on some of the IT top stocks, right? So just bringing that point in on something that we did about 8-9 months back. Right. Technically, the IT index still, definitely looking strong. Seems to be a sort of flag pattern here that is going on the weekly chart. Looking definitely better. There's a nice smart up move, a pennant here, another big up move, sort of flag come pennant, a consolidation type going on there. Some weakness on the long-term chart with negative divergence on the RSI, but I don't think anything particularly, uh, you know, uh, concerning right now. It could still go up, is my view, but obviously you're going to have to, keep track with stop losses. Not sure whether this would be a great time to enter it, given the massive event risk of tomorrow and who knows what else. But one thing going very much in the favor of IT companies is the rupee depreciation, plus the IT companies, at least things like TCS, seem to have really come out of a sticky situation in the last 2, 3, 4 years and come out much better, much stronger, and doing some good stuff in spite of the H1B issues, Trump issues, access to US market issues. Looks like they've matured and learned from lessons and are much better placed to be in how to deal with any really adverse situations. So one thing to keep in mind about IT is if you see a downturn in the market sometime, whenever there's a lot of talk about recession type cut that has to happen sometime this year, next year, never know when. Too long of a good time. From 2009 onwards, we've had some uptrends without any major corrections. So almost a decade now without any major corrections in the global markets. If and when that happens, IT space will be definitely one of those places to find a defensive, low risk opportunity. All right, so that was IT. So let's go on to the other ones. Auto, right? So auto had drawn this rising wedge several months back. Did break down, but really did not fall down like a typical rising wedge. And we're still, looking at it as a weekly chart, mind you. And oh, sorry, did I look at IT from? Yes, I changed that. Yes. Okay, going back to auto. Right. So this was the rising wedge. The market clearly topped out, once that rising wedge broke down. And now you can at best say that the auto index is in a sideways move, in spite of what you will see later, that some of the auto companies seem to be doing quite well in terms of stock prices. Some select ones, not everything. Right, we'll have a look at that. But auto clearly range bound like the Nifty itself. Capital goods. So capital goods, one of those laggard sectors which never really recovered from the 2008 crash, right? And here it is. Basically it's come back to that. Imagine after a whole 12 years, sort of 11 years, we are back there. Massive double top. Right, so much for India's economic recovery is how I would put it. The talk that we are recovering, we are doing really well, infrastructure growth and all. My submission is that if that is really happening, then the capital goods companies should have seen a massive uptick in the last 2, 3, 4 years. And well, the stocks are not talking about it for sure. And I'm more and more convinced, especially after the last 3, 4 months of reading and just contemplating, that the market knows things that we just don't know. And it's really great to be able to respect the market, stop trying to figure out too much as to why and what, and just tone down the noise in the head which is going quack 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 as to why this, why that. And if we can shut that down, then listen to this. Well, this is not really saying anything great at this point. Having said that, and I don't see how, honestly, but just having to cover both sides of the coin, if the market or the capital goods index is able to break out of 21,000 very decisively, then we could see a massive upside. But right now, to me, this looks like a really good multi-year double top that has been put in place by the market. And I really don't see this getting broken out right now. As a matter of fact, on the weekly chart, and you can see this on the daily chart also, there is a potential head and shoulder top there, as you can see. Right, so let me remove that. Clear head and shoulder top on the capital goods index. And if this breaks down, then well, you're definitely going down all the way at least to 17,000, which is a good 8 to 10% down on this index. So capital goods, like I said, multi-year double top has broken the multi-year long-term moving average, is also below the 200-day moving average, as you can see, after last October's dip and 2016, again a fall down. And this is your longer term neckline on the right. So that is one to definitely keep a watch out for. So this is also really not looking too good at all. Coming to FMCG, so this is one space which has been doing amazingly well. FMCG stocks just going from strength to strength, and life high after life high. So just want to point out 2015, 2016 double top, correction in 2016 and 2017 a breakout, and 17 entire year up move, double top, correction, up move, and still going up. So almost a 50% up move in the last 1 year on the FMCG index, as you can see, and some of the individual FMCG stocks have done tremendously well. And this is still the case. So the place to hide if you are looking to, apart from IT, is the FMCG space for sure. Right, so still looking good and healthy, long-term uptrend, weekly and daily also some uptick is there. Right. Coming to the metal space, so this is another one. So the issue with Vedanta in Tuticorin, several people murdered, right? Now flip-flops by the Tamil Nadu government, now saying that it's not going to get opened, who knows? But well, leave all that. Here's your chart, and here is what you have to notice about this chart. I think some of you have already seen it now. There is the neckline to watch, right? Can you see it? And what is that? That's another nice multi-head double stop, or not multi-head, but a complex head and shoulder top. So the left shoulder here itself is a head and shoulder. Okay, left shoulder, sort of head, and a sort of vague right shoulder. Then you got this big head. It didn't break down. This neckline here did not break down. You got this big asymmetric head, and then you're going the right shoulder, which is also looking like a smaller head and shoulder. And this whole thing is almost a 1 year head and shoulder top, right? So if I just put this down, and if you look at this, you're talking about a 1 year head and shoulder top. 1 year head and shoulder tops are extremely powerful patterns. As and when they break, you can get big downsides, right? As you already know from your Doe theory, etc., longer the pattern in terms of time and price action, the more consequential it is. So this one definitely of great consequence in my view, right? So you're talking about 16,000 to about 13,500, 10% at least, right? A 10% down move on the metal space, something that could easily happen, right? So watch out for that. Looking good on temporarily in the short term, but another head and shoulder that we have seen, right? Coming to the infra index, right? There you go. Again, you're looking at weekly chart, and again you're seeing a head and shoulder pattern there, right? Again, a head and shoulder pattern on the infrastructure index, as you can see. Please note again, weekly chart, again a 1 year head and shoulder top that is happening. So some of the big core indices, right, are showing you head and shoulder tops. Ramesh is asking a question on chat. He's asking whether Nifty sectoral indices and BSE sectoral indices are both same. Not exactly the same, but similar, right? The thing is that um, their constituents could be a slightly different, the weightages could be different, but more or less, if you were to overlap them on each other, they would more or less, I mean, if there's a head and shoulder on the CNX infra, there will be a head and shoulder on the BSE infra also, right? So here in my list, I've just shortlisted indices without trying to duplicate, right? So you have FMCG in CNX, you see FMCG in BSE also, but I prefer the BSE because it has a much longer history than the CNX FMCG, right? All right, so you just need to look at one set of them. You don't need to look at all, right? Both rather. All right, so looking at infra, that was bad. Metal, that was head and shoulder top. Coming to the power index, well, that's already started to trend down, as you can see. Again, weekly chart, 5-6 year chart, very clear. 2350, 2380 was a really strong resistance, multi-year resistance, and a very clear downtrend that is happening in the power index. So except for, like I said, the IT and the FMCG place, there's really nowhere to hide. At best, others are sidewards like auto, and quite a few others are in a head and shoulder top, multi-month, multi percent head and shoulder top, almost 1 year in duration. So if you have to and also look at the CNX 500, also more or less very much range bound. So given this view, just to come back to review something that Ramesh brought up, a triangle, etc. Yes, even if you got a uptrend, sorry, a breakout with the triangle, I would trade the long with a big pinch of salt. Uh, from the looks of this sectoral study, things are definitely not looking very bullish. As a matter of fact, I would say they're looking quite bearish overall, at best sideways. Any upside has to be traded for a short period on the long and get out of your long positions. If any longs, it can only be IT for now, and perhaps FMCG. Those are something that we will look at when we look at individual stocks in the Nifty space in the next webinar, right? So I hope this has been a good introduction. We have been talking about a sort of topping out formation situation setup happening in the Indian market for many months now, both from a technical and fundamental point of view. On the technical point of view, well, for 6 months now, and at least a 3.5, 4 month break from IMRs, I think nothing much has changed at all. There is, as a matter of fact, more evidence of potential downside moves rather than upside moves on a sector macro level basis. So with that, coming to the end of part one of today's IMR, stick around. I will send you a link for the second part where we will do a quick review of the, not the FNO stocks, sorry. We look at Nifty stocks. Right, we look at Nifty stocks, and yes, actually, as a matter of fact, there are some good perhaps investment slash trading opportunities, and it's stock specific. It's no longer sector wide opportunities as we would find in 2017 when we had a secular uptrend, right? All right, thank you. Closing this webinar, and I'll see you on the other side with the new link in a couple of minutes. Bye.